Hi guys, and welcome to my channel. My name is Refinance, and I'm a real estate agent and investor in Central Ohio. Now, unless this is your first time on the internet in the last month, you're all well aware of the economic crisis we're going through. But thankfully, there are a slew of new day trading gurus out there to help us make millions throughout this time. No, I'm joking guys, but that's one of the main reasons I want to make this YouTube video today. We've all seen the ads out there. There are so many people out there right now trying to take advantage of the market we're in and sell their products, sell their courses to make millions fast. When in most cases, the people buying these courses are going to lose a lot of money that they can't afford to lose in the first place. While the prospect of making money fast is exciting, 9 times out of 10 it's not realistic without taking on a ton of risk. However, the average investor can still grow their money throughout this time with substantially less risk and historically great returns. In this video, I want to discuss how anyone, especially the average investor, can come out of this recession better financially than when they went in. Unfortunately, unless you're already wealthy, it's just unrealistic to expect that you'll make millions throughout this recession. However, anybody with any level of wealth or lack thereof can come out this recession with substantially more than they went in. And by setting yourself up well through this recession, you're on the path to make millions in the future. Now, there are really 2 phases to profiting from a recession. The first being contraction, and the second being expansion. However, most people fall into one group or the other and tend to make no financial gain throughout the recession or lose more money than they already have. People who experience strong fear in economic downturns like we're in now often contract. They sell some investments, they put all their money in the bank, or worse, they take money out of the bank. By locking in your losses now through selling your assets in bad times and losing buying power due to inflation, this group of people tend to come out of recessions with losses that set them back for years financially. However, on the other hand, you have the expansion group. When they see the market down 20%, they take a significant portion of their money and put it into the market to take advantage of lower price investments, which on the surface seems like a great idea. However, expansion before contraction can be extremely risky due to the fact that none of us know when a downturn will end. And if not properly prepared, you could end up needing that money that you invested long before the recession is over, and now be forced to sell assets at a loss because you didn't take the proper precautions and contract before expanding. You shouldn't waste time, however, in this contraction phase. The goal throughout these 2 phases are to first protect what you already have and make sure that your family is protected and taken care of, which of course is most important in this time. However, once that's taken care of, you're now well positioned to take advantage of the discounted market and potentially grow your wealth. Now, the first step in the contraction phase is to create a budget. Even if you were very fortunate not to lose your job during the recent layoffs, it's very important to cut out all non-essential spending. If you still have a solid job, the goal here is to save as much money as possible. While if you unfortunately lost your job during the recent layoffs, the goal here is to stop the bleeding per se and protect your downside. Step 2 is to maintain a steady source of income greater than your budget. If you've been laid off, file for unemployment immediately. I'll leave a link in the description below. However, don't rely on the government for very long. Many businesses are hiring right now, including Walmart, Kroger, some food delivery services, and they're even raising their entry-level hourly rate to incentivize new employees at this time. In almost every situation, it's going to be more profitable to find a new job instead of relying on unemployment. Once you've secured a new job, or if you never lost your job in the first place, the goal is to see your income substantially greater than your expenses. This could mean it might be time to get a new side gig. For example, Postmates, Grubhub, all these businesses are hiring and under extreme demand right now. It all depends on your situation and how much you want to take advantage of the market. If you have children or there's other circumstances, it might make it hard to find time to have a second job. However, the people who put in the most effort and sacrifice now during the bad times are going to come out much farther ahead than those who relax during these bad times. Step 3 is to create a 3 to 6 month emergency fund. While this step should ideally be done before a recession hits, this is imperative to make sure you have the funds set aside before we start investing. This emergency fund should not be put into stocks or any investments that are risky, however, that should be set aside in a high interest savings account such as Ally or VO Bank. The most important thing right now is to keep your family safe and healthy throughout these times. And if you were to lose your job again or have an unforeseen emergency, you want to make sure you have money set aside so you're not forced to sell investments in the bad times and take losses. Step 4 is to refinance debt. If you own a house or have credit card debt, now is the time to refinance and get that to a lower rate. Credit cards should be paid off and consolidated with personal loans that usually have much lower interest rates, or even the proceeds from a house refinance or investment property. The primary purpose of refinancing your home or maybe a rental property would be to lower your interest rate and lower your monthly payment. However, when done with caution, it could make sense to pull some equity out of your property to make it available for the expansion phase. Please keep in mind, though, that by pulling out equity in a refinance, your monthly payment will most likely increase if not offset by your lower interest rate, and therefore that could be a little risky because it'll bump up your expenses. So please make sure you have plenty of margin when it comes to your expenses and income if you're considering a cash out refinance. Step 5 is pretty self-explanatory, but it's to not lose money or lock in any losses right now. If you were to refinance your house or an investment property, as we talked about in the previous step, the most important consideration is to not lose money. So when we do the refinance, we want to make sure that the monthly payment does not go up to a point where it would put stress on our budget. We want to make sure our income is always greater than our expenses with a good, healthy margin, so that way we don't lose our home to foreclosure or miss monthly payments. And finally, when it comes to individual stock accounts or retirement accounts, it's very important to not sell anything right now. It's very important to not sell and lock in losses now after we've seen a decline in the stock market, and then you'll be out of the market to not take advantage of the eventual gain. Now that we've contracted and protected the downside, it's very important to not stop here, but it's very important to move forward into the expansion cycle. If you stop here like most people do, you'll protect your current assets, but you won't be able to take advantage of the market and profit from this recession. When done safely, recessions are a great time to invest and a great way to increase your financial situation moving forward. The first step of the expansion phase is to increase your cash position as much as possible and as quickly as possible. This was started in the contraction phase through saving up a 3 to 6 month emergency fund and also increasing your income over expenses as much as possible. However, this continues to be vital throughout the whole cycle. The more cash and buying power you have at this phase, the more you can take advantage of the downturn in the market. The second step of the expansion phase would be to invest as much money as you can safely and in simple investments. Now is not really the time as a beginner to try more advanced investing strategies such as day trading, trading options, or futures. While these can provide huge profits to professionals, they're also a great way for beginners to lose a ton of money. In good times with a good job, if you're willing to lose some money to learn how to day trade, then by all means. However, in bad times right now, when cash is already tight, jobs are not really secure, it's a very good idea to invest in investments that are simple, understandable, where you have a good chance of making money and a very low chance of losing a lot of money. Personally, as a real estate agent and investor, I obviously prefer real estate over the stock market to make my money. About 70 to 80% of my net worth is currently in residential rental property. The reason I prefer real estate over the stock market is my ability to safely leverage the investment. So for example, if I put 5% down on a property and I find that property 5 to 10% below market value, then I've already increased my equity in the property 100 to 200%. Now, of course, this is a very simplified look at real estate. I'm not taking into consideration selling costs, but I'm also not taking into consideration future appreciation, cash flow, and the tax benefits. I'll make a future video about investing in real estate. However, one thing to consider when investing in real estate is that it's very important to make sure you have plenty of cash flow. We don't want to just bank on appreciation, as the market can go up and down short term. We want to make sure we have plenty of cash flow to cover our repairs, any other expenses, and our mortgage, insurance, etc. Even in bad times, rental income doesn't tend to go up or down too quickly. So rental properties are a great way to provide extra income for you and your family in bad times and in good times. However, unfortunately, if you've lost your job recently or don't have 2 years of work experience, maybe you have bad credit or can't get a co-signer, real estate really probably won't be an option for you unless you can get a little creative, which once again, I'll make another video in the future on creative techniques on how to buy real estate. So if at this time real estate isn't for you, your best option is going to be investing in the stock market. When it comes to investing in the stock market for beginners, dollar cost averaging is very important. That means spreading out your investments into smaller, consistent investments and not one lump sum. So for example, if you want to invest $400 this month, you'd instead invest $100 weekly for the month. None of us know when the bottom of the market will be, and it's shown historically that dollar cost averaging in versus trying to time the market will lead to much higher returns. You want to be investing on a weekly basis an amount of money that you can afford that won't put too much strain on your budget, while also not touching your emergency fund. That money should always stay in a high-yielding savings account. If you're a beginning investor and you're just getting started in the stock market, I recommend Webull. I also use Robinhood as well. But if you sign up for Webull, you get 2 free stocks just by depositing any amount of money. So if you are interested in using Webull, go ahead and check the description below for my referral code so you can get your 2 free stocks. Now, these investments in the stock market should be in low-cost exchange-traded funds or ETFs or companies you understand. A couple ETFs you might consider are full market ETFs like Vanguard's VTI, or you can get a little bit more risky and invest in market sector ETFs. One market sector that has taken a beating lately is the airline industry. So if you wanted to invest in the airline industry because you feel it's going to go up in the future, you might consider buying JETS ETF, which is a exchange-traded fund of different airlines that are publicly traded. However, this is definitely more risky than investing in a full market ETF, as we don't really know if the airline industry will ever regain full profitability and the price point that it was a month ago. The third and final step is just to keep a level head throughout this whole downturn and to hold long term. Over the upcoming months, we're sure to see more market volatility. We'll see prices soar, prices decline. The fear of this virus and the downturn in the market is sure to wreak havoc on stock prices. It's important to continue to invest consistently and in small amounts through this whole downturn, in amounts that won't put a strain on your budget or put your family at risk. It's also very important to stay the course and don't get lured into the get-rich-quick schemes, the starting new businesses during this time, taking up day trading, things like that. Prices are sure to rise and fall over the next coming months, and while it can get frustrating and it might be easy to get lured into picking up day trading or some other way to make money faster, for the beginning investor, it's really ideal to just make your investments consistently and in small amounts and to hold long term. Thank you all so much for stopping by and checking out this video. I really hope I could provide some useful content to you guys today. And if you enjoyed this video, please go ahead and give it a like. Also, if you have any questions, please feel free to leave me a comment. I try to answer all of them. And if you are looking forward to more content like this in regards to investing in real estate and personal finance, please subscribe to my YouTube channel. I'd love to see you guys back here. Thanks again. Have a good day.